Hey traders, welcome back to another video. Fair value gaps may not be what you believe. Many traders misunderstand and misuse them, which often results in steady losses. In this video, we're going to completely break down the idea of fair value gaps, one of the strongest but most often misread tools in trading. We'll cover all the various types and patterns of FVGs you'll find on your charts. Even better, I'll guide you on how to identify high-probability fair value gaps and trade them more precisely by applying clear, repeatable rules. I'll also reveal my two preferred FVG setups, explaining them step by step so you can apply them immediately regardless of which market you trade. If you find this useful, don't forget to like the video and subscribe to the channel if you're new here. I'll see you after the intro. Welcome back traders, and let's dive right in. So, what exactly is a fair value gap? An FVG appears on your chart when the market makes an unbalanced price movement, usually triggered by a sharp push in one direction with no real pullback. These forceful moves leave behind areas where liquidity was bypassed, in other words, price inefficiencies that show up as gaps between candles. Such gaps often act like magnets, pulling price back toward them over time. Because of this, FVGs are high probability zones for possible trade setups. Price typically reacts once it revisits and rebalances these points. And before we dig deeper, let's do a quick recap of what inefficient price delivery actually means. There are three main types of price inefficiency. The first is fair value gaps. These usually form over three candles where the wicks on either side don't completely cover the body of the middle candle. This leaves a distinct gap traced from that middle candle's body. Price often comes back to fill this zone, making it an important level to monitor. The second type of price inefficiency is volume imbalances. This happens when there's a mismatch between the close of one candle and the open of the next. Even though trades occur, the volume isn't spread evenly. These zones can also draw price back as the market aims to balance out. The third type of price inefficiency is opening gaps. The simplest to spot, they appear between a market's last close and the next session's open, with no candles in between. These gaps usually get filled fast, making them great for short-term trades. Now let's break down the psychology behind why fair value gaps matter and how price behaves around them from a structural angle. Zoom into a lower time frame and examine the three-candle setup of a fair value gap. You usually notice a strong push upward backed by solid buying pressure and a clear lack of sellers. This burst of momentum leaves behind an unbalanced price area, what we call the fair value gap. Here's where psychology comes into play. Many traders miss that first impulsive leg and wait for a retracement. They set buy limit orders at key spots like demand zones, order blocks, or the FVG itself, expecting price to return. These pending orders form a pool of liquidity within the gap. Since the market always hunts for liquidity to fuel its next leg, it drifts back to this area. Because demand outweighs supply at that point, price usually pushes higher until it finds a strong supply zone with enough sellers to bring balance. At that stage, the market often starts a short-term pullback. Why does this happen? Because it must fix the inefficiency caused by the initial surge. Price comes back to the fair value gap, hits those resting buy orders, rebalances the area, and then continues trending with even stronger momentum. This is what makes fair value gaps so powerful. They're not just simple chart patterns, but liquidity zones formed by actual market action. Understanding this concept gives you a true edge. You're no longer trading only what's visible on the chart, but you're trading according to how. Why it forms? Fair value gaps usually fit into two primary models, the classic model and the inverted model. Let's begin by unpacking the classic model, which itself is split into two main types. The first type is buy-side imbalance, sell-side inefficiency. This kind of fair value gap shows up during a sharp upward price surge where sellers had minimal or no chance to take part. The outcome is an imbalance, a gap with missing sell-side activity. The market often revisits this zone to offer a fair chance for sellers to step in, making it a prime area for possible long entries when price pulls back. The second type is sell-side imbalance, buy-side inefficiency. It develops during steep downward moves where buyers don't have a fair chance to participate. Because of this, the market generally retraces upward to provide balanced buy-side action before potentially moving lower again. Within any fair value gap, there are three key price levels every trader needs to watch. the premium high, the top of the gap, the discount low, the bottom of the gap, and the midpoint, often called the consequent encroachment. Now you might ask which of these levels holds the most significance and how to use them. The midpoint of the fair value gap is the most important because it marks the 50% level of the gap. If price revisits the fair value gap and respects this midpoint, it's typically a strong sign that price will continue moving in its original direction. For example, with a bullish buy-side setup, if price moves back into the gap and pushes past the midpoint without showing any rejection, it often signals that the bullish imbalance is no longer valid and the market is likely to drop further. Now, let's shift to the second fair value gap model, the inverse fair value gap. So, what exactly is an inverse fair value gap? An inverse FVG forms when price does not respect a normal fair value gap. Instead of reacting or rejecting, price cuts right through it. When this occurs, the original gap often flips its role and starts acting as either a support or resistance level, depending on which way the breakout happens. This idea reflects the same principles as supply and demand zones. Just like a broken supply zone can switch to demand and vice versa, fair value gaps can also change roles. Suppose we have a bearish FVG formed by a strong downward move, but instead of reacting there, price blasts through it with two clear bullish candles. In this scenario, the original bearish gap turns into an inverse FVG that now acts as a support zone. When price returns to this level and respects the midpoint, the consequent encroachment, it often keeps pushing higher, showing how the gap has flipped and is now backing the upward move. As I noted earlier, not all fair value gaps carry the same trade potential. Some setups have a much higher chance of delivering profitable trades. So let's break down the 4 key criteria for spotting high-quality FVGs, the ones with the best odds of success. The first criterion is FVGs that form inside kill zones. Fair value gaps that develop during major trading sessions like the London or New York kill zones generally have a higher probability of playing out well. For example, if a gap forms during the active trading hours of the London or New York session, especially during distribution phases, it's usually more dependable. These time-based FVGs often hold more institutional significance and deliver higher success rates compared to those that show up outside major sessions. The second criterion is FVGs at market structure breaks or shifts. Gaps that emerge during a break of structure or a market structure shift tend to be statistically more reliable. When a fair value gap forms directly from structural momentum, like a clear breakout, it signals strong institutional involvement. These FVGs are often retested before price continues its move, offering solid trade setups. The third criterion is an unmitigated FVG. A strong FVG must stay untouched, in other words, unmitigated. Once price comes back to fill or tap into a gap, it loses its value as a trade setup. Think of FVGs as single-use areas. Once they're mitigated, they're no longer dependable for entries. However, how price reacts when it first enters the FVG can offer valuable clues. If price respects the zone and bounces, it's probably serving as support and could push price toward buy-side liquidity. But if price breaks through and closes past the FVG, it flips into an inverse FVG, now working as resistance, making sell-side liquidity the next probable target. The last criterion is FVGs found at market extremes. Fair value gaps situated at market extremes usually provide the most dependable setups. These spots, either at the top or bottom of a market swing, are much more significant than FVGs forming in the middle of a range. In an uptrend, you should target FVGs that develop in discount zones, as these often present the best entry points for long trades. On the flip side, in a downtrend, focus on FVGs sitting in premium zones to pinpoint high-quality shorting setups. These strategic levels help you maximize your risk-to-reward ratio and keep you aligned with the main market trend. Now, let's dive into the fair value gap strategies I personally trust, methods that deliver reliable results when applied correctly. We'll start with one of the most dependable FVG trading strategies that combines the classic fair value gap model with a liquidity sweep, a combo that works extremely well in both bullish and bearish scenarios. In a bullish market, this setup triggers when price sweeps a key sell-side liquidity level, like the lows of a demand zone, a major swing low, or a cluster of recent lows, and then immediately taps into a bullish untouched FVG. After filling the gap, price usually makes a sharp reversal and keeps pushing higher with the trend. In a bearish case, the idea is the same but flipped. Price targets buy-side liquidity such as the highs of a supply zone or recent swing highs, then reacts to a bearish classic FVG. The crucial point in both setups is that the liquidity sweep happens right before price reaches the unmitigated fair value gap. This alignment often leads to strong directional movement. Why does this setup perform so well? It's not just about chart patterns. The power of this setup comes from the market psychology behind it. When the market sweeps liquidity and at the same time mitigates a fair value gap, it clears out two major barriers: the liquidity void shown by the fair value gap and the stop-loss orders of early traders caught on the wrong side. So, how do we trade this setup? To trade it properly, place your buy limit order at the top edge of the bullish fair value gap. Then, target the nearest buy-side liquidity zone, usually sitting above a recent swing high or a cluster of highs. Let's break down a real-world example using the 5-minute chart of GBP/USD. The pair is clearly trending upward with multiple bullish break of structure moves. Suddenly, price dips under a recent swing low, seemingly showing weakness, but instead of dropping further, it taps right into an unmitigated bullish fair value gap just below that low. This dip does two things at once. It sweeps sell-side liquidity and mitigates the fair value gap. Right after this confluence, price bounces hard and continues the main uptrend. Zoom in and you'll see a new liquidity pool building just above a freshly formed fair value gap. Since all the ideal factors are in place, liquidity sweep, unmitigated fair value gap, and trend alignment, this sets up a textbook trade. Just set your buy limit at the top of the new bullish FVG and aim for the next clean high as your take profit target. Now, let's move on to the second strategy: trading inverse fair value gaps. We'll dive into a more advanced and highly effective trading strategy that combines breached FVGs with liquidity sweep patterns to create a high probability setup that matches institutional price action. Let me explain exactly how you can use this method in real time. Here's the 1-hour chart of EUR/USD, where the broader market structure is clearly bearish. Price first sweeps buy-side liquidity just above a recent structural high and then fills an inefficiency. Almost instantly, price reverses sharply, showing a shift in momentum and setting up a possible move towards sell-side targets. Next, I drop down to the 5-minute time frame to refine the entry. What I'm looking for here is a breached bullish FVG, meaning price didn't respect the gap and broke straight through it. This flips the FVG into an inverse fair value gap, now more likely to act as resistance instead of support, and that's exactly what happens. After the liquidity sweep, price drops below a bullish FVG and closes under it. This breach confirms the zone has flipped, forming a dependable resistance area. On top of that, we get a market structure shift, adding another strong layer of confirmation for a bearish setup. So, how do we trade this setup? With multiple points of confluence now in place, liquidity sweep, structure shift, and inverse FVG, we can get ready to enter the trade. Thank you for watching. Just set a sell limit at the lowest boundary of the inverse fair value gap and aim for the nearest sell-side liquidity on the current time frame, or target a higher time frame liquidity pool if you're looking for a bigger move. Now, let's see how this trade unfolds. Price climbs back into the inverse FVG zone, which now acts as resistance. Price reacts to the inverse FVG and drops lower, eventually reaching the take profit target, completing a clean textbook play and confirming the setup. This strategy highlights the real strength of inverse fair value gaps, especially when combined with liquidity sweeps and market structure shifts. It gives you a clear, rules-based entry method that lines up with how institutions actually move price. That's it, traders. If you got value from this breakdown, be sure to subscribe and turn on notifications so you never miss fresh content. Drop a comment below if you have questions or ideas for future videos. Your feedback helps the channel grow. Thanks for watching, and I'll see you in the next one.